Here's how it goes for most people. They decide they want to start investing. Great decision. Then they start paying attention to the news. And the news is, well, the news. Market at all-time highs. Risky time to invest. Market dropping. Better wait for it to stabilize. Election coming up. Too much uncertainty. Inflation high. Better hold cash. Interest rates rising. Wait and see. Recession fears. Not a good time. There is always a reason to wait. Always. The news cycle is designed to feel urgent. The financial media runs on fear and hype. There is never a moment when everything feels perfectly calm and safe. And so people wait. One more month. Until after the election. Until the market pulls back. Until inflation cools down. Until things just feel a little more certain. And the months turn into years. And the years compound, not for them but for everyone who ignored the noise and invested anyway. This is one of the most common and most expensive financial mistakes regular people make. Not because they're irresponsible. Because the hesitation feels completely rational. Today we're going to show exactly what that wait cost. Real numbers. Real timelines. Real dollars left on the table. Let's start with a fundamental truth about the market. The market does not wait for you to feel comfortable. It compounds whether you're in or out. Every day you're on the sidelines, the market is doing something. Sometimes it's going up. Sometimes it's going down. But over time it has consistently gone up more than it goes down. And the people who are invested even imperfectly capture those gains. The people waiting for the right moment don't. Here's the research that should end this debate. A study by Charles Schwab looked at 5 investing strategies over a 20-year period. Strategy 1: perfect timing. Investing only at the exact market low each year. Strategy 2: immediate investing. Putting money in on January 1st every year no matter what. Strategy 3: dollar cost averaging. Spreading investments evenly throughout the year. Strategy 4: bad timing. Investing only at the exact market high each year. Strategy 5: never investing. Keeping everything in cash. Results after 20 years? Perfect timing $138,000. Immediate investing $135,000. Dollar cost averaging $134,000. Bad timing $121,000. Cash only $44,000. Read those numbers again. The person with perfect timing, the absolute best possible scenario, did only slightly better than the person who invested immediately on January 1st every year without thinking about it. The difference between perfect timing and immediate investing was less than 2.5%. But the person who stayed in cash? They ended up with less than a third of what even the bad timer accumulated. The lesson is not that timing doesn't matter at all. The lesson is that being in the market even at the wrong time beats staying out of the market almost every single time. The risk of bad timing is small. The cost of not investing is enormous. Now let's put real dollar amounts on waiting. Same scenario, someone deciding whether to start investing $400 a month. They're 28 years old. Assuming 8% average annual returns. Start at 28, portfolio at 65. Roughly $1.4 million. Wait until 30, portfolio at 65. Roughly $1.2 million. Wait until 35, portfolio at 65. Roughly $790,000. Wait until 40, portfolio at 65. Roughly $520,000. Waiting 2 years costs roughly $200,000. Waiting 7 years costs over $600,000. Waiting 12 years costs nearly $900,000. From the same $400 monthly contribution. From the same investment strategy. The only variable when they started. These numbers make the cost of hesitation tangible. It's not a small rounding error. It's not a minor difference. It's the difference between financial freedom and financial dependence in retirement. Now let's address the most common timing objections head on. Objection 1: the market is at an all-time high. Shouldn't I wait for a pullback? This feels logical. Buy low, right? But here's the reality. All-time highs are not rare events. The stock market spends a significant portion of its time at or near all-time highs. Because the long-term trend is upward. Studies show that investing at all-time highs has historically produced returns just as strong, sometimes stronger, than investing at random times. Because after an all-time high, the market often continues to new highs before it corrects. And even when it does correct, the recovery brings it back to new highs again. Waiting for the pullback often means waiting through months or years of additional gains only to then buy after the pullback has already recovered. The pullback chasers usually end up buying higher than where they were waiting. Objection 2: there's too much economic uncertainty right now. There is always economic uncertainty. Seriously. Look at any moment in the last 100 years of market history. Wars, pandemics, recessions, political crises, inflation spikes, banking collapses. Name a period of genuine, complete economic certainty. It doesn't exist. Uncertainty is the permanent backdrop of all investing. The market has powered through every one of those uncertainties over the long run. Waiting for certainty is waiting for something that will never come. Objection 3: I want to wait until I understand more. This is the most nuanced one because learning before investing is genuinely good. But there's a line between learning and using learning as an excuse to delay. For most people, a simple index fund strategy requires very little knowledge to execute. Open account. Buy a total market index fund. Set up automatic monthly contributions. Don't touch it for 20 years. That's it. The complexity most people are waiting to master before starting, they don't actually need it for a simple long-term strategy. More knowledge is always good. But it doesn't need to precede the first contribution. You can learn and invest at the same time. Objection 4: I need to pay off debt first. This one has nuance. High-interest debt, anything above 7% or 8%, should generally be paid aggressively, because a guaranteed 20% return by paying off a 20% APR card beats any realistic investment return. But for lower-interest debt, student loans at 4%, a car loan at 5%, investing alongside debt payoff often makes mathematical sense, because the expected investment return exceeds the debt interest rate, and because time in the market during your 20s and 30s is irreplaceable. The right answer here isn't always one or the other. It's often both simultaneously. So what's the actual move? Start now, with whatever you have available, in a simple, diversified index fund, with automatic contributions, not when the market feels safer, not after the election, not when your salary is higher, not when you've read 3 more books. No, because the research is clear. Being in the market even imperfectly beats being out of the market waiting for perfect conditions. Every single time, over long periods. The right time to invest is not a date on the calendar. It's a decision. A decision to stop waiting for the world to feel comfortable enough to act, and to start letting time work for you instead of against you. Like if this gave you the push you needed. Subscribe and share this with someone who's been saying they'll start investing when the time is right. The time is right. Start now. Stay consistent. Let time do the rest. See you in the next one.